Are you guys trying to figure out how to get financing on Canada's hottest and most trendiest investment type? Well, make sure you stay tuned to the end of the video because we drop all the knowledge for you.
Hey guys, Josh and Ehren back for another Finance Friday, and we're excited to come and talk to you guys today about something that is a hot topic right now. We are going to break down the 4+1, but not in the way you might think. We're going to break down financing of these, all the different types of financing available. It's been around long enough now that people are starting to realize the most optimal way to do it, some of the pitfalls around using certain types of financing. So we want to dig a little bit deeper today into how to finance these and what you should think of when you're actually getting into a project like this.
Yeah, I think like you said, this is the most common entry point for the newer investor developer that's taking advantage of some of the zoning changes, and for those guys that are getting into development for the first time, it's obviously one of the easier ways to be able to get in. Obviously you could just slap that garden suite into the backyard, but today we are actually taking a look at the ground up construction, and obviously there's a lot of different options out there to be able to get these financed. There's your private, your semi-private, your banks, and then is CMHC an option for construction financing for projects of this size? Because we got to take a look at the loan sizes and whether or not that's even a viable option. And these are the things that we take a look at, right? And your biggest determining factor in terms of what type of lender and what type of product is going to be essentially your loan size, right? The loan size is really going to dictate which type of lender you're going to be able to go to, because first things out of the gate, regardless of your experience or how much liquidity you have, if your loan size is too small for certain lenders or for certain types of projects, you're not going to be able to get that financing for your project. And then you're going to be stuck taking a look at something else. So I think that's where we just want to come in and try to give you guys that guidance.
Yeah, I think that the CMHC product as a whole has been something that has been sold to the population as the savior kind of financing solution, and it doesn't necessarily work in all cases. It's important for people to look at past the minimum equity required in a project from an underwriting perspective, and maybe start to take a look at other things like tranche time or actual liquidity required to take on a project, or experience or net worth, a handful of different variables. So I'm really excited to get into it and take a look, but going off of what Ehren said, loan size seems to be the first mitigating factor. For a lot of the lenders out there right now, most of them don't want to touch, smaller loan sizes, for at least for CMHC. So if you have a loan size, let's say under $8 million, it would be discretionary. A CMHC lender is going to look at your deal and they're going to ask a handful of questions in regards to your net worth and liquidity. But the loan size in particular, if you're outside of the GTA and you have like a $2 or $3 million deal, it is going to be pretty difficult to be able to get that done directly with CMHC.
Yeah, and not even like the difficulty, even if you can get it done, the cost on it is for most of these major lenders like comparable to almost private rates. So in that case, is it even worth it to go with CMHC out of the gate at that, from that type of pricing? I mean, most construction lenders are probably starting about like 2 million. Like the majority of them that are doing the construction financing probably want to see something about that 2 million. Anything in that $1 million to $2 million range, there are lenders out there that are going to take a look at it. But again, it's just there aren't as many who want to take on the smaller loan sizes, simply because the cost of doing a transaction it's the same. Whether you're doing $1 million, 2 million, 10 million, 20 million, from the lender standpoint, they still got to allocate the project management. They still got to allocate the lawyers to be able to, be there and do the tranching. The manpower and the time that's involved in these deals is the same. And that's specifically why you don't see the smaller stuff with CMHC as much, especially when you understand CMHC bonds and just how limited amount of money or, bond allocation, money allocation there are for the CMHC bonds. I mean, we're end of 2024 when we're shooting this video, and the 5-year bonds, or a lot of lenders are running out of bucket money for that type of product. So again, the lenders that are doing these big dollar value transactions are going to want to save the money for the big guys, and not going to allocate that stuff to the smaller deals, unfortunately.
Yeah, so let's take a look at options in regards to loan to cost. So like equity injected in a project. So when you guys are looking at doing your 4+1, obviously you're going to underwrite your file, and the CMHC underwriting, if you do qualify, is going to provide 95% loan to cost, meaning you technically 5% equity position in your project, whereas a private lender or a mortgage investment corporation is usually going to max out at highest 85% loan to cost, or 65% of the as complete value, and then your bank is going to be 70% loan to cost, 75%. So your bank being the obviously cheapest financing option available other than an insured product. A lot more liquidity required, no net worth requirements, whereas your private option is going to give you less capital required in the deal, but it's going to be more expensive. So when we're looking at really diving into which option is going to be best, obviously we're going to take a look at capital injected and what actually needs to be done or injected in the project to make it work. But that's not the only factor we're actually going to look at.
Experience with construction is obviously a huge indication and a huge vetting file that the lenders are going to take a look at when determining whether or not they're going to approve your project. As many of you probably seen the news, there's a lot of big projects that have had some issues and some big headlines lately, and even the big guys have issues with their projects, right? So from a lender standpoint, your top tier financing, your banks or credit unions, like your prime financing rates and stuff like that, these guys are going to be looking for someone that has experience with the type of project that you're bringing on, right? If you've self-built just individual standalone homes before, but you're looking at building a 6-story wood frame building, those individual townhome type projects don't translate to a 6-story type building where maybe you have elevators and stuff. If you've built wood frame before and then you're building with concrete, again, the translation from wood frame to concrete, it's not there from a lender and what they're preferring to see of the experience. So that's something that we're going to take a look at. If you do have a builder in mind, or if you do have your own resume, we can float that by the lender, put together your CV, show us the projects that you've done. We'll run it past them. They're either going to be okay with it or they're not. And then they're going to give us a recommendation as to, hey, we want to see more experience with this type of project. Those are going to be your big guys. They're going to want to see the developers, the professional GCs. Now, one reason why you might go to one of the private guys is they can sometimes be a bit more flexible with the amount of experience that you have. So if you've built out, whole neighborhoods of townhomes, maybe they're okay with you, managing your own project if you're building something small. Especially for this one where we're talking about a 4+1, you could probably get away with doing your own project if you have that experience. So the semi-private guys, they can be a bit more flexible. When we take a look at CMHC deals, they're going to be your most strict when it comes down to the experience. They're going to want someone that has a proven track record, lots of experience, and again, they want to feel sure and safe that the deal is going to get done, because especially on these small deals, it's impossible for a lender to be able to sell off, a $2 million construction budget, probably even less on a 4+1. The appetite for someone to come in and take that deal over just isn't there, and there's not enough margin in the profits for the lender to sit on it and then try to find a buyer. So they're going to want to make sure that it's going to get done. There's not going to be any issues, and they're not going to be trying to sell a project halfway through.
Yeah, and on top of experience, the financial backing of a developer is arguably the second most important thing behind experience. And financial backing can come in multiple ways. It can come in pre-existing equity that you have. It can come in liquidity that you have available, home equity lines of credit, or actual equity that you can draw from. Some of these lenders have net worth requirements, and these net worth requirements can be challenging if you are looking to get your feet wet or scale up into this type of development. So if you're looking to qualify for CMHC on the onset with your 4+1 construction, you're going to have to prove a net worth requirement. So 25% of the total loan amount you're going to have to prove as you're submitting to CMHC. So if this is going to be a challenge because you're using all of your cash equity to actually build this thing, evidently this might be a roadblock for you, because you can't use the equity or capital injected into the actual project itself on the onset. Whereas, secondary lenders like a mortgage investment corporation or the bank, they don't necessarily have a direct personal net worth requirement on the submission of a multifamily development project. So if you aren't necessarily hitting that, or you need to use your liquidity to get to the point, of getting into CMHC, that might be a better option for you. Realistically, there are some ways to be able to bolster that additional net worth. A handful of times we'll see clients take on partners, qualifying partners, somebody who does have the net worth backing to be able to get these projects across the finish line. A lot of the times when we're going through credit with our CMHC files, you'll have questions around does this person have the ability to be able to make a capital call if required? Construction financing is easily the most capital intensive investment in real estate you could possibly make. No one ever comes to us and says that happened faster than we thought wanted to or cheaper than we wanted to. It legitimately doesn't happen. So net worth is a major component in actually getting these buildings and developments off the ground. If you don't necessarily have the qualifiable net worth on the onset for the construction, CMHC construction debt might not be the best for you.
Yeah, and then just continuing off that too, even if you're building non-CMHC up front and your goal is to still go into CMHC on the back end, we still got to make sure you have that equity requirement, whether that's up front or whether that's on the back end. Again, like maybe you have some projects that are closing and you just need to wait. But again, like if you're exit to CMHC at some point before that submission, we have to be able to show that equity. So that net worth. So again, keep that in mind. Doesn't necessarily have to be up the front, but even on the back end into CMHC, still got to be able to show that net worth. And that may even be a more important thing to consider, because if you're one of these guys that have multiple projects on the go and you're not building CMHC up front and you're putting that capital to work in other projects, again, you got to remember you're gonna have a project closing in 12, 16 months with CMHC, or at least going into CMHC at that point, where you're gonna have to show that net worth requirement. And if you're spending that money and you don't necessarily have the assets in your personal name or in the subject corp to qualify, you're going to be a tight spot come financing time on the exit.
Yeah, I mean, there are a handful of ways to be able to verify that net worth. One of them being appraisals on real properties. So if you do think it's tight and it's not blatantly obvious to us that you have the net worth requirement for the takeout, we're going to want to cross our T's and dot our I's and make sure that you either get appraisals on assets to ensure you have the net worth there to make your exit successful.
Yeah, and Josh might have touched on it, but I can't remember. But CMHC is also not considering the equity in that project, right? So if you have $1 million at the end of the day in your project and you're at 95% loan to cost, CMHC is not just going to give you that $1 million in the subject project towards that net worth. They want to see equity and net worth outside of the subject property to be able to help qualify. So again, don't bank on that as well, that hey, I got some equity in there and that's going to be able to cover it.
Yeah, the first one's the most difficult. Once you get the first one done, you can use that equity as a net worth to be able to move on to the next.
Yeah. One of the other things you're going to want to consider when you're choosing your lender is how do they tranche out the money, and how quickly are they going to get that money to you. Your order of slowest to fastest is going to be CMHC by far, your most time intensive in terms of getting that money back. Then just your uninsured bank type financing, and A-lender banks, credit unions, and then your semi-private mix are going to be really the most quickest. CMHC can be all over the place. When you have CMHC, you have your QS consultants involved as well too. So you're going to have to go in through them. They're going to have to send those invoices and reports over to the lender. The lender's going to have to deal with that. You can be up to 4 to 6 weeks sometimes waiting for CMHC to get those tranches to you. So when we take a look at that timeline, going back to what Josh was talking about earlier about having capital, in today's market, there's not as many projects going on. A lot of the contractors, they want to be getting their guys paid. They want to be doing jobs that are going to be paying them. If they're sitting, 4, 6, 7 weeks and they're not getting paid, you're going to have to put that money out of your pocket, get them paid, keep them on the job site. Some of these guys may require deposits on the material as well too, right? That's not really something that you can cover on the deposit. You got to put that money down ahead of time. So again, make sure you have that equity, and then make sure you're understanding the timelines of when these tranches are going to take place. Your credit unions, your A banks, you're going to be somewhere probably around the same time, 4-ish, maybe 5 weeks, but probably around the 4-week mark. So again, just keeping that in mind and understanding how long it's going to take from, when you get that work completed to when you're going to be able to get that money back from the lender. Now, your fastest guys, that's when we're taking a look into our private guys, our mortgage investment companies. Now, these guys can turn things around in a week, usually, most likely, maybe in a week and a half, depending on how complicated, the time of year, how busy it is. But it's exponentially quicker than what you're going to be doing and waiting for when you're dealing with the CMHC and the big bank guys. And that's a huge thing. There's a lot of mid-sized developers who would prefer to go the private route just because the whole process is quicker. The tranches are quicker. The application timeline is quicker, right? We know CMHC can take 3, 4, 5, 6, 7 months, depending on the time of year, what policy change they've had out, who's on vacation, right? That's a long time to be able to wait just to be able to get the financing on the project. These semi-private, these mix, they can close on the property if you're using them to purchase 4 weeks, 5 weeks if you got all your ducks in a row. The tranche times are much quicker as well too. So when you start taking a look at your carrying costs and how long you're going to be in the project for and what that does to your interest, when you're comparing a week to get your money versus 6 weeks, 7 weeks to get your money, I mean, that can easily add 2, 3 months sometimes to your overall timeline. And again, just what is that doing to your bottom line? How much additional money are you having to put out of your pocket? So, and these are the intricacies that are really going to kind of make or break your project, right? Like how frustrated are you going to be in the middle of your project when you're trying to get your guys to stay on site, you're trying to get money to them? Are you scrambling around? Are you trying to borrow money? I mean, not that you should be borrowing money in the middle of your project, but I mean, let's be honest, guys run out of money and then, now you're stuck trying to scramble, borrowing more higher interest debt, right? You're just putting more stress on your own financial situation and your own bottom line. And these are the things that aren't really talked about, but are huge intricacies and very important in the construction process.
Yeah, and I think like that goalpost moves consistently. So, for people who are looking to choose between whether or not you want to take a MIC or you want to go with a bank or you want to go with CMHC, for example, the rules around having a house on the actual site itself. So specifically, CMHC will not let you submit an application until the house is completely demolished and you pay for it. Now, the challenge with this specifically is that if you bought a house with a mortgage on it, 9 times out of 10, that lender who gave you a mortgage on that house isn't going to be cool with you demolishing the house and then submitting the CMHC. So, just understanding the intricacies around, can I demolish the house? Do I have to cover the cost? Do I have to buy this land in cash? Like, can I get my demolition funded with a MIC? Like, how does that process work? But so many intricacies around it, but obviously I think it makes sense to weigh all those and determine really like the application processing time as a whole. Like it's probably the most important under focused thing that I see from most developers is everybody wants to go to the CMHC route and then they realize like, am I going to sit on this $1 million house in private financing for 6 months as I start to go through this submission that I might get?
Yeah, that's not including the 2 years it took to get the permit too. So it's 2 years, 6 months. Yeah, I mean, I think most mid-sized investors and developers, the underestimated cost is how long you're going to be carrying that cost for. And realistically, a lot of these closings probably get done with private financing, especially if you're buying land, because you're not really getting bank financing on raw land. And yeah, how long are you going to be carrying that for? And after you wait all that time to get your permits and approvals, do you also want to be waiting for CMHC? Now, we can submit into CMHC before, so I mean, we can mitigate that, but just because we submit early doesn't, there's no mitigation that they're going to take their sweet time with the files. So.
Yeah, absolutely. I think one of the most important reasons and by the reason why people listen to us is just a finger on the pulse of interest rates and what that looks like for costs. So let's dive into the cost and the difference between them all. Obviously, this is one of the most important factors when somebody's looking at getting a construction loan. It affects your bottom line and it affects the profitability of your project. So CMHC can provide the absolute best financing terms possible for very large projects. I've seen some CMHC loans that are prime minus when you're above $50-60 million. Realistically, if you're looking at the 4+1 and your loan's like $2 or $3 million, you're probably like prime +2, maybe prime +1.5 if you're a super strong borrower and you have a previous relationship with a lender who's willing to do a favor. But realistically, the financing terms on these small construction loans are not overly favorable to the point where you're like, man, that's a crazy deal. I should have, went with conventional financing. So, keep in mind that loan size has a direct impact on the cost of borrowing on these loans, and these smaller loans are priced accordingly. Now, that being said, if you were to take a look at a mortgage investment company, for example, they do offer higher leverage, they offer more flexibility, they offer sometimes less experience, but they are more expensive. You have to give some to get some. So usually these can be priced, obviously depending on loan size, but anywhere between prime +3 to prime +4.5. These can be a little bit sharper, obviously depending on locations. If you're inside the GTA, the appetite for these loans are much higher than if you're outside the GTA trying to do this in a secondary market. Lender fees, those lender fees can range from 1.5% to 2.5%. If you have a relationship with a lender who's doing this, pricing can vary, but that's roughly where you're going to see a Mortgage Investment Corporation come in on something like this. Last but not least, if you're going to go to the bank, this is going to be the cheapest financing. We're roughly seeing prime plus 1.5 to 2.5. Really depends, again, location, bank, what you're looking to do. The differentiating factor here is going to be probably 0.5 basis point to 1 basis point on the actual rate that they're offering, but the lender fee, they range between 0.5 point to 1 point. If you take a look at, you're doing a $3 million project, even 1 or 2% can be $30,000 to $60,000. So, carrying costs on those loans are much more favorable than going with a MIC, but you require more equity in your project and a little bit more red tape. So, the financing terms available throughout all of them are almost the same. We're taking a look between a swing of 4% from the most equity to the least equity, but talking about all the different factors today, price isn't the only thing you should really factor into consideration when you're looking to actually take on a project like this. Flexibility, equity, refinanceability, do you have a project on site, a handful of different variables you should take into consideration, but this is roughly what you're going to expect when you're in the open market today.
Yeah, and two, just in terms of the pricing, like specifically for CMHC, understanding that, the availability or the option for brokers now to go get a COI and shop it, it's not there anymore. So if you're working with a broker and they just bring you one LOI and they're like, here, sign this, and they haven't given you any other options, especially on the smaller CMHC stuff, ask for a second opinion, or work with someone who has relationships with multiple different lenders that they're going to be able to price it out with at least a couple different options, so you can take a look and see where that comes in at. Because I'm seeing even good deals where your construction is $9 million and lenders are still pricing it at least like a floor of 9.7%, which is pretty high for a construction loan of that size. So just understanding that the relationship your broker has with the lenders can also be beneficial for you in your pricing. We've seen it where we've been able to get slightly better pricing because we have that relationship with the certain lenders. So again, especially on the construction projects where you can quite easily add 6 months to your construction timeline, the more favorable terms you can get on the interest rate for sure, the better it's going to be in your bottom line, and it's just going to be that much more easier to manage.
Dan, you brought it up earlier. It's just like also capital allocation. Right now in this market, as many of you probably could understand, there isn't an immense amount of free capital in the market. You talk to a lot of these construction lenders, they're picking and choosing the developments that they want to lend on, and they're doing that by a handful of different ways. Obviously, location, strength of borrower, but the relationship with the broker is bringing them the deal. Do you bring them consistent deals? Do you bring them good deals? Do you bring them good clients? Are they past clients? There isn't unlimited money floating around right now for the world's riskiest investment. Realistically, lending on construction is right above lending on land, and land is pretty tough right now. So just keep that in mind, that there isn't the printer isn't on. That there is capital restrictions in the market right now, and your project needs to be sold, and it needs to be sold like a story. And they need to outline who you are, what your project is, how it works, your relationship with us, our relationship with them. So keep that in mind in a market that is very quickly squeezing.
Yeah, I think just last thing, exiting out of this, ironically exiting out of your construction project, just because you can't get construction financing with CMHC upfront does not mean that you can't get the term financing with CMHC on the back end. It is substantially easier to get term financing, especially on smaller stuff, $1 million, $1.5 million to $1 million to $2 million. It's much easier to get it on the actual built and stabilized product than it is on getting the actual construction financing. So again, if you can't get CMHC construction, it does not mean that you can't get CMHC on the takeout. And you should know before you even get your construction financing whether or not you're going to be getting CMHC, or at least where that CMHC underwriting is going to put you at for your takeout loan size.
Yeah, as you guys can tell, there's a handful of different variables you need to take into consideration when taking on your 4+1 project, or any development project for that matter. the goalposts continue to move, but we do our best to keep on track, on top of all the different changes with CMHC and our lenders. If you guys got value today from this video and you really liked what you heard, feel free to reach out to Ehren or myself. We're happy to sit down and just discuss your project with you. It's really important that before you start your project, you talk to a broker who understands all the steps of your project, who understands how to underwrite your project when it's complete, who understands how to put you in a construction financing option that's going to work for you, that's going to underwrite your deal in a conservative way, especially in a market that we're in right now. So, there's never been a better time to reach out to an expert who does this all day, every day, and Erin and I love what we do. So if you guys did like this video, hit the like button, hit the subscribe button. It allows Erin and I to shoot more content like this for you. Thanks.